Good evening, everyone, and like she said, welcome. So our presentation is on film fraud and fixes, choosing film production tax incentives that maximize stakeholders' value while minimizing fraud. And this is the Accounting 631 Fraud Examination class taught by the wonderful Dr. Karen McGuire.
She gets bonus for that, by the way.
And our objectives. Our first objective is to conduct an analysis of film production tax incentives, which we'll commonly refer to as film PTIs, available across all 50 states. We'll also discern potential frauds for the various types of film PTIs. We'll recommend a mix of film PTIs that minimize the potential for fraud, provide adequate incentives for the clients, allow states to promote themselves as supporters of in-tax film production, skilled job creation, and local small businesses. This is our wonderful main agenda. We're going to give you some background information such as who are we and what is the overall goal. We're also going to give you the scope, which defines PTIs, and it tells the types of film PTIs. Then we're also going to tell the types of film PTI fraud, which includes what is fraud, what are the types of tax incentive fraud, and then the scope of the preventative actions of PTI frauds, which include the common methods to prevent fraud, along with the techniques that we use to the techniques used for film PTI fraud. That was a mouthful, y'all. And then we're going to give the recommendations, which include a mix of incentives to benefit the industry in the state of South Carolina and other interested states. And then this is just a very nice visual of the objective,
Process.
Process, yes, thank you.
Well, as you probably know, we are the graduate students enrolled in the Masters of Accountancy program here at Coastal Carolina University. We conducted this research as a part of our fraud examination class taught by Dr. McGuire. The clients for these projects operate in different sectors of the filming industry, and they include the TLC's Trailer Park, Welcome to Myrtle Manor, the Weinstein Company, A&E's Vital Transport, and the Jupiter Company. The working in collaboration, this project aims to assist our clients in their tax planning efforts while evaluating filming locations for their upcoming projects. It also aims to help South Carolina or any other interested states to demonstrate their interest in building filming industry in the area, and also commitment to achieve best practices.
To illustrate how damaging the fraud can be not only to the perpetrators but also to the states and its taxpayers, we would like to share a story. This is Daniel Adams, the director of The Lightkeepers and the Golden Boys movies, who defrauded the state of Massachusetts of more than $4.7 million by submitting fraudulent budgets, bank accounts, investment documents, and falsified inflated salary contracts for lead actors to take advantage of the production tax credit. His troubles began when, after filing for bankruptcy protection in early 2000, he found it difficult to finance his movies. And near the end of 2009, Adams was desperate to finish his latest movie, The Lightkeepers, but was running out of money well before the shooting ended. But instead of shutting down the production, he submitted the falsified documents to take advantage of the state's 25% tax credit program enacted in 2006. In particular, he claimed that he paid $2.5 million to his lead actor, Richard Dreyfuss, while in fact his actual salary was only $400,000. In addition, he submitted eligible production expenses to the Department of Revenue of more than $6.7 million, when the true cost of filming was $2.3 million. As a result of these schemes, Adams received more than $3.6 million in overpaid tax credits, which he subsequently sold to Walmart and Bank of America. Fortunately, his triumph was short-lived when the state auditor discovered the fraud. Adams was arrested in 2010 and pled guilty to 10 counts of embezzlement. He was sentenced by a judge to up to 3 years in prison with 10 years of probation upon release. He was also ordered to pay $4.4 million in restitutions back to the state on the top of the $20,000 debt he already accumulated from the previous movies. Adams was released from prison in 2013, and despite the permanent stain on his reputation, plans to continue his filming career. But the question is though, what other types of production tax incentives can he take advantage of?
Adams or any other perpetrator given opportunity would have taken advantage of different types of PTIs. Today we are going to discuss the various types of PTIs such as film incentives, non-refundable, refundable tax credits, cash rebates, grants, exemptions, and the others. Production tax incentives are tax benefits offered on a state-by-state basis throughout the United States of America in order to encourage in-state film production. The structure, size, and the type of the incentives vary from state to state. Proponents of the incentive program point to the increased economic activity and job creations as the justification for the credits. Others argue that the cost of the incentives offsets the benefits, and they also say that the money goes primarily to the out-of-state talent rather than to in-state cast and crew members. Some studies of costs and benefits of the incentive programs show different levels of effectiveness. PTIs also act as a temporary financial incentives to attract industries such as film production and manufacturing in order to conduct their operations inside the states. In general, PTIs apply to any production or manufacturing activity. And for this presentation, we refer to the applicable incentive as a film production tax incentives. However, the benefits of in-state film production were not quickly realized by the state and were only implemented by recent years.
Thank you. As you all may be aware, there's a lot of money to be made in film production. And annually, there's north of $30 billion being earned in economies for television, and south of $30 billion for movie production. Canada, back in 1997, in order to get on board with the money-making opportunities for the economy, they went ahead and set up their own tax incentive program. And it was very successful. And by 1998, the Monitor Group determined that Canada deprived the United States economy by over $10 million. Louisiana got into the act in 1991. They decided, hey, listen, this is a good opportunity for us to get a little money into the economy. So in 91, they started to get into the movie production incentive program. And the next 3 years, Louisiana made a boatload of money. And by 2009, Louisiana went from the first state in the union to do film production to 44 states doing film production. Tonight, what we want to do is talk to you about these tax incentive programs. One's going to be the grants, another one's going to be the cash rebates, a third one's going to be tax credits, and a fourth one, sales tax exemptions. The most interesting one is the fee-free location opportunities that are granted to these film production companies. Grants is free money. Anybody that has a grant, they know that it's not paid back. You don't have to pay it back. You get the money from the government entity. You have to write a grant proposal. And also, it comes with your compliance. You have to be using the money for certain things, but once you're accountable for it, it's free money and doesn't have to be repaid. The North Carolina grant program, they have up to $10 billion. And the first 25% of the money being spent is available for the grant program. This all started just in January this year in North Carolina. Now there's a couple features on this grant program. One is the $5 million feature film cap. Also $5 million on video, films, and televisions per season. And on commercials, there's a $250,000 limit. The other program, they have rebates, and they're offered by certain states. And again, it's anything that you spend out there that's qualifying for the rebates, they're given up to 25% back if you qualify and your expenditures don't go overboard. And some of you are going to see that later on that some people go overboard in expenditures and trying to claim things that shouldn't be claimed. So there are reporting requirements for that. The South Carolina Wage Rebate Program, it's pretty nice if you hire South Carolina residents. It gives you a 25% cash rebate, where opposed to if you hire out-of-state employees for your production company, you only get a 20% rebate. Now, of course, some poor guys have to be careful because if you go over $1 million in earn wages, you don't get the rebate. It's a little bit too high for them. So you have to stay under that $1 million limit. And the other thing about this program is that all these incentives, you have to come under the South Carolina wage withholding requirement. So you can't just be, hey, come on in, we'll give you money, don't worry about your taxes. You have to pay your taxes to be entitled to the rebates.
All right, so we'll go over some other PTIs. Another one's called tax credits. So it's pretty simple. It's used to overall just kind of offset or reduce the overall tax obligations for any of the production companies. And also, there's usually a minimum requirement that has to be spent in order to qualify for these tax credits. There's two main types: refundable and transferable. So we'll go over those in just a second. Okay. This is an example for Georgia's tax credits. So it's pretty laid out. They have a 20% base transferable tax credit. They have a 10% Georgia entertainment promotion, and that allows them to pretty much anytime something is Georgia-oriented is promoted through production company, whether it's at the end of their film credits, they'll get a 10% credit for that. And of course, they have a minimum which is of $500,000. So you have to spend at least $500,000 in order to qualify for a lot of their tax credits. They don't have a cap, so it looks like South Carolina had a cap. Georgia actually doesn't have a cap, so you can spend as much as you want, and you'll still qualify for your tax credits. So there's no maximum spending limit. And both residents and non-residents actually qualify for a lot of these tax credits. All right, so we're going to go over refundable tax credits. What this does, it allows them to reduce their overall tax liability to below zero, and they can actually get a refund credit from that. So pretty much when the film production, once they're like this example is $1,000. Once you're liable for $1,000, based on all the tax incentives that you would have got from maybe like we were talking, like I said, about the logos. If it qualifies and you earn a lot more credit, you actually get that money back. So, and the difference between that is, of course, a non-refundable. So even if you spend $1,000, or even if you have a liability of $1,000, and you get tax incentives that go against that, you can only get up to you don't qualify for any tax credits after that. So you pretty much just bottom out to everything equals out to zero. So you don't qualify for anything. Or not necessarily don't qualify for anything that you once you have the liability for your taxes, that's you can only get to zero. You can't actually get a refund below zero, so you can't actually get money from that. Transferable tax credits, pretty simple. Once the production company qualifies for certain tax credits, they can then sell their tax credits to another production company. It's usually less than the face value what they actually were going to achieve. And then that company can then use that to kind of offset their overall tax liabilities for whatever it is that they're doing for their films or such. All right, another PTI is to sell tax exemptions. So it's pretty simple. They're exempt for certain taxes that they may accumulate. One of the examples here is for lodging. So when the film production comes, they need a place for a lot of their people to stay at. And the minimum usually is about 30 days, so they can actually stay at those places and actually not have to pay the taxes for staying at those particular residencies. And There's other specified expenses too. We'll go over that in a second too. This is some examples. And Virginia is a really good example. So a lot of the production companies are exempt from the 4% sales tax. And it's usually, it has to be qualified, there's usually activities that usually qualify for this. So they're not exempt from all taxes, just for particular ones such as purchasing and developing film, materials that are used for like costumes and props, heating and air conditioning for the sets, scripts, drafting, and design supplies. So anything that usually deals with the production of the film is usually qualifies for leaving a tax exemption. Also, we have tax-free locations. This allows companies to go to specific areas within the state, and they actually don't have to pay any type of taxes when they go to these particular state-owned properties, such as state parks, grounds, buildings, and universities. And South Carolina is one of the states that actually offer it. So it's a small number of states that actually offer that, and South Carolina actually is one of those. All right, so there's some public opinions and pros that when we go to this. One of the things that people believe that when these film productions come to these states, that it creates a lot of jobs. So it provides a lot more opportunities, especially for a lot of the lower income areas in particular states. And the other thing is that it promotes a lot of economic growth within those areas too. So a lot of people, especially like the lower income areas, they experience an upturn in their economy, so they're actually able to do a lot more. So here we have economic growth and improved lifestyle. So a lot more cash money coming in that particular area, and a lot more cash flow coming in that particular state. So it makes states a lot more competitive for trying to get these film production film industries to come into these particular states.
All right, now we'll go over some advantages of the production tax incentives. Like Anthony was mentioning, increased spending in production localities, especially in rural areas that might not necessarily see a lot of production, so not your metropolitan areas, but a good example is like Asheville, North Carolina for the Hunger Games. And going off that also increases film-induced tourism. So Asheville is not necessarily a tourist destination, but since the Hunger Games have been filmed, a lot of people have gone there and they've actually constructed their own little economy around giving tours of filming locations, things like that. With that, so the Hunger Games, again, going back to that, we'll see multiple films in the series. If a production company is returning to the same place to film multiple movies, episodes of the TV show, what have you, the more that happens, the more you're going to see increased need for the higher paying or higher skilled labor. We're talking, not necessarily your carpentry and your blue collar things, but film editing, production, stuff of that nature. Also, another advantage we're looking at is with production companies coming in, you're obviously going to generate some more tax revenue. If you're not filming, you don't have these production tax incentives, you're not getting that revenue from those production companies. So there also are some negatives with production tax incentives. The main arguments against them is that this money can be spent in other areas. Namely, within the state, you're looking at a healthcare and education improvement as opposed to trying to spur or maybe create an industry that's not there. The other argument is using those tax incentives to lower the overall tax rates for the citizens. Let's see. And so with the production companies getting the tax incentives for filming maybe in rural areas, there's some negative things that can happen with that as well. You could see, a production company come in for a year to 18 months, film their movie, their TV show, what have you, and build up the economy in a small town, but as soon as they leave, they might have created more infrastructure, built more hotels, and all of a sudden there's no one there to use those facilities, use that. That ties along with the short-term economic effects and lack of sustainability. So if they're just there for the one movie, it's a great spot for that, the desert scene or what have you. That's really all that they're going to be used for. It can also be seen as a political tool. As most things can be politicized, this certainly can as well. The localized narrow benefits is something that you can see with South Carolina. If it's filming in Charleston, that's going to be the only place that's going to see that growth. You're not going to see in the smaller areas around Charleston if you're just filming in the bigger areas. The other thing is, from the filmmaker's point of view, a lot of times you have to be approved by the Film Commission of the state before you're eligible for the tax incentives, and if the state might not like, what's going on in film, portraying the state negatively, you can't have an accusation of censorship as that as well.
Now that you've kind of gotten a background on production tax incentives, we're going to be focusing on a few key states that we've highlighted as important in the production tax incentive environment. We've identified California, Georgia, Louisiana, and North Carolina as important states. The film production economy as a whole, the United States has about 650,000 jobs related or directly or indirectly, and pay about $47 billion in wages throughout the year. Now, California, as we expect, takes a big portion of this, having about 350,000 of those jobs and spending $18.2 billion a year. Now, as you can see, there's a huge drop from California to Georgia, which Georgia pays about $1.6 billion in wages and employs about 31,000. Now, as you can see, it continues to drop from there, but I want to put a major focus on South Carolina, which employs about 5,000 and pays $139 million in wages. Now on the map behind me, we've color-coded each state to represent which production tax incentive that it offers. Starting off with the light blue, which includes South Carolina. These are your rebates and your grants. The next category is your navy blue, darker blue, whatever you want to call it. These are the refundable tax credits. This one includes North Carolina. Our third category is our red states, which includes California and Georgia. These have transferable tax credits. And our last one in our smaller category is our green states, which have a transfer to state at a discount. As you can see, there are some states that aren't colored as well. These are your states that don't offer production tax incentives at this time. Now that you've kind of got a background on what states offer, now I want to dive directly into California, which is the major, which has the most of the production of films. Right now, California offers a 20% tax credit for non-resident employees and a 25% tax credit for resident employees. This is used, that extra 5% is used to keep people to stay in the state and to continually use the employment and the services that are offered within California. California has set a minimum threshold of $1 million for most of their production, but as you can see, miniseries is capped at $500,000 just because they don't expect them to spend as much. But there are some limitations. The only people that can transfer their credits to unrelated industries or unrelated parties is the independent film.
Georgia is also one of our other highlighted states. It was already discussed a little bit before. They offer a 20% credit right off the bat. It is transferable, and they also have an additional 10% credit they offer if the Georgia state logo is placed in the credits or another negotiated location. They do have a minimum spending of $500,000, but they don't have any caps. So they can spend as much as they need to and still be eligible for that credit. An interesting thing about Georgia is they also have a camera ready program, which is they have trained associates that will help in permitting and scouting and all of that stuff that's related to production. Another state is Louisiana. According to the Film Production Capital, they are ranked one of the best states to film in based on their tax incentives. They have a 30% transferable tax credit, and all the expenses need to be in state though. They also have a 5% payroll tax credit for in-state residents that are employed. They have a $300,000 minimum, but like Georgia, they do not have a cap, so they can spend as much as they want. The transferable credits, they can either be transferred to in-state taxpayers or paid back by the state for 85% of the face value. An interesting fact about Louisiana is in 2013, the 5 largest independent films were shot in Louisiana.
Next one we're going to talk about is North Carolina, and they actually recently replaced their tax incentive program with a grant program, and that is an allocation of $10 million. It's split into 3 different expenditures, which is features, television, and commercial projects, and there's a maximum on 2 of those at $5 million and $250,000. From 2012, North Carolina was rated 5 stars in filmproductioncapital.com. And since this new grant program has been introduced, they're moved down to 1 star. South Carolina, they have non-refundable tax credits, which are commercial production, which 10% of the total investment, and then constructions, anything that leads up to the actual production of the film is 20%. They have cash rebates for employees and stuff. Wage rebate is 25% of in-state residents and 20% of out-of-state residents. There are minimum spending such as $250,000 sales, and they can use tax exemptions there. $1 million spending limit, like he said earlier, and the limitations are all credits cannot reduce income tax liability by more than 50%.
All right, so we're going to talk about the types of fraud that is out there for production tax incentives. We're going to do the definition of what fraud is. Fraud triangle, which encompasses the different aspects of why a person would commit fraud. And then we're going to cover the incentives to overstate and understate and go over the types of fraud itself and examples. And this is the most basic definition they can give us for fraud, which really isn't that basic, but it really comes down to one person taking advantage of someone else by falsely representing information to them. And then our fraud triangle, which encompasses 3 different aspects. You have the opportunity, where you have the failure to have systems in place to prevent people from stealing or lying to you or misrepresenting their information or not checking it. The rationalization of, I'm underpaid, I'm not getting what I deserve, so I'm going to take this to compensate for that. And then there's the pressure of having financial needs, such as bills, that they can't afford to pay for, and they're going to steal or lie in order to make up for that.
In typical business, it might seem more common to understate, to increase your bottom line and to get more back from your company, especially the people in charge, so they can get bonuses and things like that. But in situations like this in PTIs, it's really common to actually overstate your expenses to get more rebates. So ultimately, it's kind of like free money. They're reporting expenses that they never really had, and so they're getting more back. Some types of fraud that we have found. This is a short list of them, like embezzlement, making false entries in your book, which is kind of what I explained earlier, omitting income in general, keeping 2 separate books, one that reflects the reality and one that is what you're using to submit. Also, here's 3 more. So false submissions. They're submitting false information to the tax board and to get their PTIs. Also, wire fraud is really common, as well as false entries in their book, which I mentioned before.
So for an example of a fraud that's happening, we have Peter Hoffman and Michael Agata. One man's a producer and the other one's a lawyer. They're charged with conspiracy and 5 counts of wire fraud and false submission. This includes fake bank transfer statements, vendor payments, and internal accounting. Both men have currently pleaded not guilty. And to go back on what Grace said, the vendor payments do increase their expenses, so they can get higher rebates from the government and everything, so that would be their incentive to falsify these statements. Another one that's a little more commonly seen, or more well known, is Horizon Entertainment is covering the Saints dance team. They've received over about $1 million in tax credits, and they're supposedly spending $5 million. However, when it was looked into, they spent less than $250,000.
All right, another example of tax fraud, tax credit fraud. George Costage, he issued and delivered more than 500 million of fictitious checks. If found guilty, he faces a hefty prison sentence, supervised term of release, a fine, and forfeiture of proceeds from offense. Gregory and Walker of Bishop LLC. Pretty much he reported that he had tax credits for resale. He was able to sell those for over more than $2 million. He was sentenced with 70 months of imprisonment, 3 years of supervised release, a restitution of almost $2 million, and a forfeiture of almost $1 million.
Now that we've talked about the different ways to commit fraud, PTA fraud, we have the red flags that are kind of seen if fraud might be committed. Red flags are just warning signs that might be committed. That might show that fraud is being committed. And it does not mean that fraud is present. It just needs to be looked into more. We have separated it into 3 different categories: employee fraud, management fraud, accounting fraud. I do suggest that you do pay attention to this, because you can make a portion of what like the IRS or the SEC gets back from this. One man received $140 million back from that. So it does pay to notice things like this. And then first we have employee fraud, and the first example of the red flag employee fraud is the lifestyle changes. Now this could be kind of evident if someone's making like maybe $50,000 a year, and he comes into work with maybe like a Bentley and buys fancy clothes and jewelry and stuff, and just basically living outside of his means. And so that's definitely a red flag. You kind of got to know like what is going on here. Another one is if you have debt problems, stuff like that. Kind of like they mentioned, the fraud triangle. One of the essential characteristics of it is if perceived pressure. And the guy is you have perceived pressure if you had some financial issues and need to make up for that. Another one is behavioral changes. Definitely if you have like mood swings and stuff like that, and they kind of see this as like a Jekyll and Hyde thing. It's like you come in one day and you're a nice manager, you give gifts to your employees and stuff, and the next day you come in and just real rude and autocratic. And the next one is high employee turnover, and this could be because like employees come in and they might see like, oh, something's going wrong here, and I need to, they might think I need to get out of here before they might get in trouble for that as well. And another one is refusal to take vacation and sick time. Now I know if my boss comes up to me and asks me to take vacation time, I'm gonna take it. I mean, I don't know about y'all, but that's definitely gotta be a simple clue for a red flag for fraud. And the other one is lack of segregation of duties. As we all know, authorization, custody, and recording, and we don't want anybody to have any of those two their abilities to their job for fear like if they're like an accounts payable, if they're paying away checks and stuff like that, and they also record it in the reconciliation. You might be able to pay a vendor twice and then record it and just kind of keep it under the wraps that way. So definitely want to keep that. And now that I've talked about the employee side of the red flags, I'm going to hand it over to Forrest, who's on the management side of it.
Thanks, Rick. Well, now we're going to be talking about the management red flags. A few words about the management fraud first. It's different kind of fraud. It's distinguished both by the nature of the perpetrator and also by the method of deception. The most common form of the management fraud will be top management level involved in manipulation of the financial statements. That's how actually the management fraud is known also as a financial statement fraud. In a couple slides, we'll introduce some of the most common and most known red flags that are related to the management fraud. The first one, and definitely, I would like to really to pay attention to these slides. There's like one of the most common red flags are on these slides. The first one, the reluctance to provide information to an auditors. In general, auditors will do inquiries from their clients. That's a simple asking of questions about the culture of the company, about the control environment of the company, and so on. The reluctance of providing information could be a signal of the management trying to cover some information from the auditors, and also will lead to
lack of trust between the business and the internal or external auditors. Another common red flag will be the management decisions that are taken by one or a small group of persons. And the one that I really want to talk about is the weakness of the internal control environment. In our world, the internal control is seen as one of the most important controls. Sorry. It's a key participant actually in the anti-fraud activities in the organization. And when we talk about a lack or weakness of the internal control, some examples will be lack of segregation of duties, lack of physical safeguards, or lack of proper authorization. And one of the most common will be in frauds will be overriding an existing internal controls. There's a few other listed red flags in this slide, but I would like to talk about the next slide actually a little bit more. This will be the high employee turnover rate. As Derek mentioned, one side of the turnover rate. I would like to explain another side of the high employee turnover rate, and that will be the high turnover rate usually leads to a low morale in the organization, and also it's a signal of unexperienced staff, which is viewed as a red flag.
Okay, so accounting red flags focus on how a fraudster is committing and concealing their crimes. Common red flags occur in payroll and purchasing and inventory, and they pose a threat to the company because it's a sign that their company funds are being misused. Excessive overtime could be an indication of a fraudulent payroll scheme. During a slack period, it's not very common for employees to be working overtime. If you notice that employees are being charged overtime and they don't normally work extra hours, you might want to investigate the hours they worked a little bit further. Budgets can also raise a red flag for payroll fraud. If there are great variations between budget costs and actual costs, there's a chance that payroll costs can be inaccurate. Employees with duplicate addresses and social security numbers, or those with little withholding or payroll deductions, could be an indication of fictitious employees. Fraudsters will often record time and issue checks for these non-existing employees and cash the checks for themselves. When it comes to purchasing and inventory, there are a number of red flags that could raise suspicion. Listen to your employees and your honest vendors, and if they're often complaining about services and products, there could be something going on. There should be a relationship between increasing sales and increasing purchases of inventory. The more sales you make, the more justified it would be for an increase in inventory purchases. Companies should also maintain sufficient physical security over their assets to prevent theft. Also be sure to take a look at documents and procedures. Every charge to accounts payable should have a shipping document to match. Companies usually purchase from the same vendors, so frequent purchases from new or unimproved vendors should raise a red flag as well. A vendor's address can also be an indicator of fraudulent purchases. Always check the physical existence of a vendor's location or matching employee and vendor addresses if you're suspicious. And finally, if there's excess inventory or low turnover, there could be a sign that your employees are appropriating inventory for personal use.
Okay, so another one of the red flags, we do another danger signals is, first thing, documentation. Documentation is very important. It helps us verify legitimate transactions. It also helps us catch errors, whether they are fraudulent errors or if they are errors that are done just on accident. It's especially important on the adjusting entries. Adjusting entries, for those who are not CPAs or accounting majors, adjusting entries are done on a company's books at the end of the accounting periods. They're done to the temporary accounts. These temporary accounts are revenue, cost of goods sold. Things that can be easily manipulated by overstating or understating them to hide the fraud. And what happens when, at the end of the period, we do these adjusting entries, we take the balances, we put them into retained earnings, which is an equity account. And then those accounts are returned to zero. So if there is any discrepancies on the balances, it is lost. The paper trail is gone, and I'm not gonna say it's impossible to find, but it's a lot harder if you don't catch it before the end of the accounting period. Also, the incomplete and untimely bank reconciliations. Bank reconciliations are our most important internal control on how much cash the company actually has control of how much we actually have in the account and available to us. So what happens is with the bank reconciliations, we use it to discover illegitimate payments, illegitimate transactions, and this is done by, or even alterated, even especially alterated checks. Because, there's a big difference between a $100 check and a $1,000 check. And the way we do this is by looking at what the bank has dispersed, what it gives to us, and what have we cleared, and we compare that, and we can catch fraud that way. And also errors that, increased customer complaints, maybe, maybe not, could be inferior products, vendor kickbacks from cost of goods sold, maybe. Write-offs for inventory or cash storage documentation. Write-offs says you did it, have no documentation, you can hide misallocation of inventory as well as cash by just writing it off. So again, documentation. Unrealistic performance expectations are, we're talking Enron, basically. This is a pressure, remember the fraud triangle? This is perceived pressure to perform. It might encourage people to overstate or understate their liabilities. Rumors and conflicting of interest, that is basically people that have a undisclosed interest in a transaction, and they use their influences to cause that to occur, whether it's for the advantage of the company or not. Using duplicate invoices to pay vendors. I send out 2 invoices, the checks, the invoices, the company pays them, one comes back, I cash the check, goes in my pocket. So always look for the duplicate invoices. Frequent use of sole source procurement contracts, this is mostly bidding. When you use only sole source, frequently there is a chance, high risk for fraud, because I give them the bid, we overbill, I pay them, they give me a little bit of the money back to my hand, I pocket it. And so that is a big red flag. And there's new legislation to focus a little bit more on that and control sole proprietorship contracts.
What we have here for you is a couple ways to keep you from preventing fraud. Independent states need to have audits done to get the tax incentives. That would be one way, having an audit done to keep you from committing fraud. Tax programs should be made transparent and accountable. So your tax incentives should be transparent for everybody to see, so that also will give you a way to keep from doing fraud. You also should report dollars for each full-time equivalent job. So what that means is your employees keep up with their hours. This one, you should verify legitimate vendors, because vendors in every business commits fraud this way. You should establish dual review process. with your vendor so that you know who your vendors are. That'll help you keep from committing fraud. You should validate the vendors with the W-9s, like e-business, tax IDs, phone numbers, addresses, banking accounts. You should also do background checks, and every business does background checks.
All right, so Julie has given you a couple of methods for effective prevention, and what I'd like to go ahead and do is, one, just kind of focus us back on this idea of fraud. And remember that fraud is basically, its root is dishonesty. It's people being dishonest and for purposes of greed or personal gain. And so before we go much further, because one of the things I'd like to address in the next two slides is why we're telling you to use these effective methods of prevention, are two things. One is the Association of Certified Fraud Examiners. They are the world's leading and largest collection of anti-fraud CPAs. So they are the world's largest anti-fraud organization. And the other thing that I'd like to bring to mind and just give you a little bit of background on, particularly if you're not in the financial world, is the Sarbanes-Oxley Act. And the Sarbanes-Oxley Act came about in the wake of the big corporate scandals that came through in the late 1990s, early 2000s. And so there were a lot of financial adjustments and laws that were put into place with the Sarbanes-Oxley Act to help restore consumer confidence in large corporations. So with that being said, part of where we are drawing these effective prevention measures from are not only recommendations from the Association of Certified Fraud Examiners, but also from what the Sarbanes-Oxley Act has already instated for publicly traded corporations. So as we take a look at these, the first one is requiring applications to be evaluated. That's actually a process that was talked about earlier, and they said that a lot of states are requiring film production companies to go ahead and have their applications vetted. So that is actually kind of carryover from what we've already been seeing states do. The second, requiring a signature of the applicants being the production companies, that if any of their information is falsified, they're willingly going to give up their economic benefits. And really, as you can see by that third bullet, kind of probably should have been tied in, but we want that to be signed not just by the production company, but by the executives of the production company. Because what we want is, we want to show a sign of good faith. We want to tell the states, we're on the up and up, we're not going to do anything wrong, we're not trying to defraud you, we're not trying to take just taxpayer dollars to pad our pockets. We're trying to do something legit here, and we want to support your state, we want to promote jobs, we're trying to do the right thing here. Not only that, but what it does is it sets the tone at the top. And in the business world, what that really means is that what the top executives are creating as far as the culture they expect from their companies is going to filter down. So if our top executives are saying, we're going to stand for high ethics, we're going to stand for integrity, we expect our subordinates to do the same, we expect our employees to do the same, then that's creating a culture of high ethics, and that's what we're trying to do here. Let's see, what else do we have? All right, a statement from the production company listing any related parties. We didn't talk too much about what we found as far as PTI incentives disappearing. But as we were doing research, what our class found was that a lot of states really don't like this idea of film incentives in particular. And what we found was that there were a lot of related party transactions occurring. That means they aren't at an arm's length. A lot of times related parties are tied into the executive management. And so there were just maybe sometimes unethical, they might have been fraudulent, but there were some not so wonderful things going on there. So again, as a measure of good faith, we're gonna put that out there. We're just gonna say, on the front end, this is what we're anticipating using, these are the people we're looking at, and we're going to disclose that this is what we plan, these are the related parties rather, that we intend on using. A statement of internal controls and any internal audit procedures. Now that is actually directly related to the Sarbanes-Oxley Act in the sense that, with the Sarbanes-Oxley Act, publicly traded companies are required to have their internal controls audited. And I believe it was Boris who mentioned earlier that weak internal controls actually contribute to an environment of fraud. Well, if we can go ahead and tell the state that these are the internal controls that we're going to be putting into place, then what they can look at is, okay, well, where are the weaknesses? And that's not only going to help the state identify what to hone in on, but it's also going to help the production company realize, oh, well, maybe I have some weaknesses that we need to address in our own internal controls. Internal audit, I want to talk about again a little bit later, so put a mental post-it note right there for a second. And then the third bullet here, creating a fraud reporting hotline for each of the states, and posting it in a public, visible location is one of the most effective fraud fighting methods by the Association of Certified Fraud Examiners. It is so effective that in their 2014 report to the nations, which is a 2-year report that's done, or a report that's done every 2 years, I suppose I should say, 40% of all fraud was caught just from a reporting hotline. Any other method was less than half of that. So in respect to actually catching fraud, this is where it's going to happen, all right? The second most effective place that fraud was caught were those internal audits. So if you're really serious about trying to prevent fraud in your company, you not only want to make sure you have a hotline, but you want to make sure you've got decent internal controls and that you're performing an internal audit. In fact, the fraud reporting hotline actually jumped to 50.9% for companies who actually had, tips increased rather to 50.9% for companies that had a reporting hotline for fraud. And if the company had a fraud reporting hotline, fraud was caught 50% faster and it cost the company 41% less. That's a pretty staggering amount when you think of the fact that you've got over $3 billion that the Association of Certified Fraud Examiners is looking at. 41% of that could have gotten caught back just by having a fraud reporting hotline. So those are some of the methods that we're suggesting. Again, not because we just say so, not because we think we've come up with these, but because these are things that states are either currently have in practice, they are things that are recommended by the Association of Certified Fraud Examiners, or they have really been put into practice in a different vein with the Sarbanes-Oxley Act. And with that being said, it may sound like we're putting all this work on the production company, but really what this does is it strengthens the production company, because what it's doing for the production company is making sure that they're getting more of their money back, that it's not being lost to fraud by their employees, but then it's also helping the state, because now the state isn't going to have to deal with trying to find fraudulent expenses or pay out or give tax credits due to fraudulent expenses. So it's really a win-win situation for everybody, and I think win-win situations make everybody happy, right? Right, okay. So with that, I will go ahead and pass it along to Mr. Zach.
Thank you. I want to start off first by saying this is great to have a packed house, and
everyone here is a special person for coming to a tax-related seminar on April 15th. So, kind of came up with that on my own, thought it was decent. So, remembering the objective, what is the reason why we're doing this? Yes, we relate it to fraud because of our class fraud examination. So we got that. But we want to look at, what do all 50 states add? What do they have for these PTIs, production tax incentives, that they are giving to film companies to come in? We aggregate all of this in a table that looks pretty nice into the white paper, so please enjoy. Put a little bit of work into it. We look at the different types of frauds that can happen with production companies. It's not a great thing to talk about, but it does happen every once in a while. And then we take what we took from the table, we then come up with recommendations that we want to give to each and every state that can help them not only create a relationship with production companies, but to help their taxpayers. Because I think everyone, even though we're trying to take the politics out of it, if you can make your own people happy, that's going to help you tremendously in the long run. So we're looking at minimizing potential fraud, providing the incentives to the clients, allowing states to promote themselves with in-state film productions, skilled job creation with local businesses. So remember those as I'm going through. One disclaimer, we are accountants, we are not lawyers. So we have not set percentages on these, that is up to the state's discretion. We're not trying to pass a bill, we're just trying to help the greater good. So our first recommendation for states is to not limit themselves with the incentives that they are going to offer these production companies by just saying, we're going to offer these to movies. We want Avengers 3 really bad in Conway, South Carolina. That'll draw a crowd. Well, you're eliminating everyone else in the game. There are so much more. You have movies, you have TV series, video games can go into there. The list it's pretty enormous that can get groups into these incentives. By doing that, you're increasing the amount of demand, if you will. More people are going to want to come here, which is almost a trickle-down effect. By having more people come in, you're getting the in-state productions. They want to get these incentives as soon as they possibly can. You're now having skilled job creation. Actors do count as skilled. That's why Wilmington has such a staggering amount of skilled workers. And it's also going to help support small businesses. Our next recommendation is to just eliminate a minimum spending cap on these projects. And what this does is, all right, so now we've taken out the barrier of any type of media can come in and they can get these incentives. Well, that's great, but all those small projects, the independent films, well, they're not going to have a chance to come in, the independent gaming, have you. By taking out this minimum spending, you minimize fraud. You're thinking, how is that possible? You want to increase your revenues and you want to decrease your expenses. Well, if you have to come to a state and there's a minimum spending of $1 million and you're at $990,000, some companies are just going to spend, or just say they spend an extra $10,000 just so they can qualify to get everything else, and that is fraud. Next, fraud's a serious thing. So, by taking out the spending cap, you're minimizing fraud, you're creating incentives for clients, so now you're opening yourself up to the small production companies, the Blair Witch projects that have huge money. Paranormal Activity, which I think had a budget of $15,000, and they're on what, Paranormal Activity 8? Like, it works. It doesn't matter how much they spend. There are other variables to the equation. It's not just how much money they're bringing in, it's how many people are going to see this movie. Is it popular, and are they going to come back and film again? So it's not a one-sided equation. In terms of supporting the in-state productions, they're going to come in. In terms of helping the skilled creation, again, they're actors. They still count as skilled. And in supporting small businesses, it doesn't matter if there's a film crew of 100 people, or if there's a film crew of 5. They need to eat. They're going to want their own entertainment, and they're going to need housing. That's money that is pumping into local economies that otherwise they wouldn't be able to take advantage of. Our next recommendation is going off of the lodging. With people, they need someplace to stay. I just learned this because at first I was just an ignorant kid. But there's a lot of tax that goes into hotels. I didn't realize. I was like, oh, I'm going to take a trip to Charleston. The hotel room's $100. It's great. All of a sudden, it's like, oh, thank you for your contributions. They're $135. Okay, that's pretty staggering. So if you look at the hotel economy. They have rooms that they need to fill. There's a variable cost of cleaning every room. There's a fixed cost that they just can't get away from. Take out if you give them the production companies incentives to come by not paying the tax, then you effectively lowered, we'll just say $15. So we're looking at $100. These hotels are capitalizing on that cost if they charge more than what the variable cost is to run the room, which I hope they would have done with a sound business model. So again, it's incentive for the clients saving money on paying tax, and it's also helping out local hotels. Next one is requiring audits. We're accountants, we had to somehow incorporate ourselves. So, by requiring project ending audits, as we talked about with how audits can take time, and how there's little frauds of how you can conceal the bank rec, you can alter some checks. By doing this, the companies know, okay, they're coming in. The fraud examiner's CPA class, they're coming in, they're gonna audit us, so we need to make sure everything's spick and span. So it minimizes fraud. The chance of, are you gonna steal from a cookie jar knowing that no one can find you? Would you do it? No, okay, well, cookie jar, think about it. You're gonna reach for it. If you know there's no chance of being caught, you're gonna go for it. But if you know that mom is monitoring the cookie jar, then you might not do it. And that's how it's gonna minimize fraud. Another thing, too, with accountants, what is the one thing Dr. McGuire says to us?
Billable hours.
Yeah. CPA firms come in and they get to have billable hours, which is how we get paid. So it helps tremendously. Oh, there's a lot of recommendations, by the way. So we go to the next one with state-specific product placement. As we know from Welcome to Myrtle Manor, excuse me on that, you put up a sign or you go to a business and tourists, they will flock. They're literally, if you look, type in Hunger Games wood tours. And they're actually doing tours, so I'm taking this one from it. They're literally doing tours of where Katniss sat, where she put herself in the tree. Like they actually go up and they say, this is the tree that Jennifer Lawrence was in. And people go and they pay money to do that. They will flock. With Lone Myrtle Manor, they've had, correct me if I'm wrong, they've had people from Canada, from Washington State, from Oregon. People will come. You put up a sign that says University Boulevard, and you have some coastal Carolina, people would come. That's how it works. So, by offering incentive, by saying if you put up a sign for Conway, South Carolina, we'll give you 10%. Automatically the client's saying, let's do it. I could save money, could you? But you look also, that is more money that's coming in because of tourists. They're flocking in, and again, they gotta eat. They're gonna wanna go to any entertainment, they're gonna wanna go to Broadway. And then you look in the local businesses, they're making money. And the big thing here is you wanna save money for the production companies and you wanna make money for your local economy. Filming during the off-season. I can say for this one personally, in the summertime, I am a shrimp cook at Provisions Company. This is not an advertisement. And we have about 40 people on staff full-time in the summer. That number, come January, it goes down to 3. 37 people are seasonal employees. They're out of work. Now, you go down the road 12 miles and you have Southport, North Carolina. Dawson Creek has been there. I know what you did last summer has been there. Safe Haven was there. Town is almost the same size of where I go, but they constantly have people there because of the production crews coming in, because of the tourists coming in and just pumping money in. So again, giving the incentive, the clients come in and it's a trickle down. Don't be too repetitive. This good? No, okay. Now, we do want to set a cap for above the line employees. So above the line are the top 5 paid people on the project. That could be actors, directors, producers, and screenwriters. Thought I had them all. So if you look, Robert Downey Jr. makes $20 million a movie. Liam Neeson just got $20 million, I think, for making Taken 3. So that can really hurt states where they come into South Carolina and say, okay, so you have a max of $1 million. I just made $20 million, I just paid taxes on 12, I want 4 back. And that doesn't do anything for these states. It actually hurts the states. And with minimizing fraud, people can say, well, okay, I was paid 14 million, let's say I was paid 15 million, I can get a bigger rebate back from the state, and that doesn't help. And what we're trying to do is help the states. Now, with a tax rebate for post-production within state facilities. This one, it took me a little bit to wrap my head around. So post-production, after all the filming is done, this is, I think, why films take so long to be made, is with all the special effects that go into CGI, fixing voices, if you will, all the finishing touches to a polished product. By offering rebates to production companies of using the same facility, we'll say in South Carolina again, they're going to have crew that are coming in here and they're doing the finishing touches. And what do people have to do? They got to eat, they got to have entertainment, they got to sleep. So it's still, even though it's not the big production, if you will, of filming, there are still people that are coming here that otherwise would not be, and pumping money into the economy. We want to talk about with the refundable credits, how we talked about how if you can get a refund based off these credits if you get below the number, or below zero, sorry about that. What we want to talk about is doing away with that and saying, well, if you want to get this credit, come back and film again, and you have 5 years to do that. So what that says to a production company is saying, okay, well, we missed out on $50,000. Why don't we go back to that same state, film there, and let's get our money's worth with these tax credits? That if you don't have the extension for the 5 years, they could go somewhere else. Again, it's about building this repetitive business so that local economies can gain on it. And now, with this recommendation, with state buying back refundable credits. So say a production company, Hunger Games Part 2, it has ceased to exist, but they still have a refundable credit left over. Well, they can't keep going because the novels have ended. They can't keep shooting because there's nothing else to shoot. What we're offering is that states could buy back the refundable credits at a discount. So in the end, they're still making money off of this. Another recommendation that we have is against brick and mortar. So brick and mortar, say a company wants to do their post-production in South Carolina. What they do is they construct this building and they get a tax credit for it. Well, this again doesn't really do too much for the state because a company can come in, erect a building, do their post-production, and leave. It's a one-time credit that you can get, that you can take advantage of. And that, again, does not help the state. You want repeat business, you want to keep getting money into the local economies, and this does not help. We also are recommending going against transferability of credits. So a lot of what production companies can do is they have a credit of $1 million. They would sell it to another production company that they know is coming into that state, and then they can use that credit. That doesn't do too much for the states. And also, we've seen with a fraud case that there was one guy that made a substantial amount of money. He was just making up transferable credits and selling them to companies, and that's not what we want. So, in conclusion, we're done with the recommendations. What we're trying to do is just to create a lasting partnership between states, between production companies that can help both. Production companies want to make as much money as possible. It's a business. And the state just wants to serve its taxpayers and make sure that they are positively affected in every possible way. By doing these recommendations, we believe that this gives a nice compromise to both sides. So from the fraud class and myself, thank you for letting us do this. Before this entire project, I thought PTI, I thought we were doing something for Pardon the Interruption. Anyone else has seen that? I thought we were doing something for Tony Kornheiser. So I know I learned a lot. I think everyone else can say they learned a lot. And thank you.
Does anybody have any questions? No? Mr. Patrick at all? All good? David?
I have a quick comment.
Absolutely.
They were talking, I guess you didn't expect it that way. You were talking about the publicity hounds and all, get from it, and just the relating experience. Probably 10 years after, I went to Savannah one time on a trip, and just scooping around. And it was probably 10 years after the movie was filmed. And I had heard of the movie, never seen it. And that was a Clint Eastwood movie, In the Garden of Good and Evil. When I I got to the hotel, they immediately showed me a tour of what happened. And it was pretty interesting. I'd never been on a movie tour before. This
So I
is where
describe
Clint
it.
Eastwood lived. This is where they filmed this. Here's a little park, we did that. So-and-so was in that house. And it was so interesting that I couldn't wait to get home and go rent the movie. It's really a good, that's a good thing.
Anyone else? Oh, by the way, oh, yes, sir.
What did, you say was the cap in South Carolina right now for PTI? I know there was a minimum spending limit and then there was a cap on it. I don't remember what it was.
There's no cap. There's no current cap rate.
There's no current cap in South Carolina?
The way South Carolina works is because it's a cash rebate system, is the state contributes $15 million to a fund every year. And they just say every year, we're just gonna throw in 15 million, whatever's left over rolls over, like rollover minutes. So, you know, they'll replace it once a year, and if they use it all up, great. If not, somebody else can come in next year and work with that as well. But Georgia is no cap. And Georgia and Louisiana are the only two states that have 5-star rankings. So, yeah, I don't think either one. Louisiana doesn't have a cap either, right?
Neither of them have caps.
Yeah, neither of them have caps.
What's the time period for the minimum spend? Like the minimum amount to
Per project.
per project, but what the project is scheduled to be a couple-year project, or is there a minimum to that, or a cap to that also?
You want me to take that one?
Please.
Okay. The state of South Carolina typically gives 1 year from the time it's approved. However, if you know you're going to be there longer, you can apply and they can waive the 1 year time frame.
And what's the minimum in South Carolina?
For spend, $1 million, right? $1 million in South Carolina. And one of our first recommendations was to allow every type of production to be, you know, allowed. So in case you're all wondering, these folks are not getting any production tax incentives because South Carolina does not believe that reality shows should get money. So even though Nikki Haley starred on a different one here in South Carolina, they're paying the full load. And how many all 50 states and how many countries?
18 foreign countries now.
18 foreign countries and all 50 states have visited Myrtle Manor. Yeah. #1 show in New Zealand, Canada, Australia. Yeah, but they're you know, left out in the cold. So that's what we're trying to do here is build the economy, because clearly they're already doing it.